Good morning, everyone. This is Nick here. Just want to make sure you can hear me. Can someone confirm in the chat room that you can hear me? Great, thank you, Danny. So yeah, I'm gonna get us started here in a moment. I'll just give people another minute or two to log in, and I'm going to share my screen so that you guys can start seeing the slides. All right, so you should see both of us right now, and I just want to make sure you're in the right class. So this is the Fundamentals of Business Finance, and this is the second of our two-part series. So today we're going to be covering the balance sheet. So again, this is Nick Henry, and I work with Community Investment Corporation. I'll tell you a little bit more about who we are here in a moment. And so I'll just go ahead and make this full screen because you're not going to really need to see me. You might as well see the slides. Great. So thanks and welcome to everyone. So I think you guys are figuring it out already. There's a chat window there on the right of your screen where you can just kind of say hello to everyone. Your audio is off. Your video is off. So I will have a couple people join later who are on right now by video, but don't worry about your video or audio being on. And yeah, I'm going to walk you through how the platform works. We did this last week, but if you're new, just want to give you a little sense of how it works. But first, I want to just introduce ourselves. And my slide is not working properly, so I'll just back it back out. But this is, you can see our little team here. We're the folks who are going to be working with you today. So I'll do the bulk of the presentation. Again, my name's Nick, and I'm on the loan team at CIC. We also have Danny on the call. He's our executive director and is just our general guru in all things related to business, and has a lot of experience both in the for-profit and the nonprofit sector. So he'll be joining us later. And then Betty also will be on the call, and she is a bookkeeper. She happens to be our main bookkeeper at CIC, but she runs her own business. And I know a lot of you guys will probably have some deep dive questions. So you can save those for her because she's the real expert. Okay, so and I also just want to introduce you to the platform a little bit and get to know you. So I'm about to activate a poll, and you can see the next question is, we want to know what type of business you run. So if you look in the polls section of the window, I just activated this question, and there are three options: for-profit, nonprofit, or other. So go ahead and just let us know kind of where you're coming from and either what you run or what you're hoping to run, just so we have a sense. And you know, this presentation applies equally to for-profits and nonprofits. Both types of businesses use balance sheets on a regular basis. I'll get into this later. They use slightly different terminology, but it's basically the same thing. Cool. All right, so mostly nonprofits, but a few nonprofits. That's great. And sorry, I went too far there. So the next question, again, these questions are not acting quite right. I might have to restart my PowerPoint, but staying in the in the poll section, we want to know how long you've been in business. So that poll is live. I'm going to restart PowerPoint because it's acting a little funny. So while you answer that, I'll just reboot here. Okay. All right, so fairly experienced, couple new people. Okay. Okay, that looks like it's working properly now. So thanks for bearing with the slight technical difficulty. Great. Okay, so yeah, just want to tell you real briefly about CIC. So we are a nonprofit, a 501c3. We're based in Southern Arizona. Our office is in Tucson. We're just right near Grant and Campbell. And we're basically an economic development organization. So we've been around since 1996, and we do this type of work through a variety of programs. We do home ownership assistance, so we're helping people, especially first-time home buyers and lower income folks, get down payment assistance or tax credits. We work with schools in a couple of ways. One is through schools who are getting financing through a bond, so we help them stay compliant with all of those rules and regulations. And more recently, we started working with families as well, trying to understand what their needs are around schools, in public schools, private schools, charter schools, just kind of trying to drive that conversation so that families have a voice in what options they have in terms of schools. And then I'm on the lending team, and then we also recently introduced some alternative funding options. So we do loans, and then we also do equity. So you can learn a lot more about that on our website. We're not going to focus on that too much today, but we did put this presentation together because we are seeing a lot of folks who are in need of financing and don't necessarily have the tools to put their application together. So the balance sheet is part of that. And so just making sure people can hear me, correct? All right. Okay, so the balance sheet. So I'm just going to quickly go over our objectives for today. They're mainly around the balance sheet and some of the concepts associated with the balance sheet. And the first one is net worth. Some people refer to it as owner's equity, but basically understanding what your business, what the value of your business is. And then we want you to have some basic familiarity by the end with the balance sheet. We want you to be able to read a balance sheet. And we would like you to be able to prepare at least a simple balance sheet for your business or your nonprofit. That will also involve understanding assets and liabilities, and I'll define those for you. And helping you understand what your business is worth. That's really the job of the balance sheet. And then we'll talk a little bit too about like what specifically the balance sheet helps you do in terms of getting access to financing. Great. Okay, so the balance sheet is something that analyzes your assets and your liabilities. And again, I'll define those in a moment. It helps you determine what your business is worth. And I referred to this earlier. Nonprofits typically use the statement or the terminology statement of financial position. Really what the balance sheet does is it helps you understand where you are financially. And then if you were on the call last week and we talked about the profit and loss, recall that the profit and loss statement covers a range of time. And the balance sheet is a little different in that it's basically a snapshot at a certain moment in time. So you might say, today, I want to know, what is my business worth? You could go back in time and say a year ago, what is it worth? So it's not really a range of time, it's that particular moment. So I'm just going to define asset for you. There's kind of a common definition of it, but in finance, what we mean when we talk about an asset is basically anything that your company owns that will help you earn cash or savings. So just to give you a few examples, we have buildings or real estate property, vehicles, inventory or raw materials. You might have equipment or machinery. Cash is one that's so obvious people don't even think about it necessarily. There's accounts receivable, so all the money that you're owed, you billed someone but they haven't paid you yet. And you might have tools, and then you would have maybe furniture or fixtures in your office, that kind of thing, desks, chairs, those types of things. So just a few examples of assets. And liabilities are kind of the opposite. Basically, these are obligations that your company has that will cost you money rather than earn you money. So you'll often see them. They often include the term payable. So a few examples. accounts payable, so this is when you've been billed and you have yet to pay. Taxes payable, wages payable. This is probably a situation where you've maybe cut a check to your employee and they haven't cashed it yet, so that's kind of sitting out there waiting to be cashed. Then we have loans, which is types of debt, a loan or a note. There's credit card debt you could throw in there. Customer prepayments, they pay ahead of time. So those are just a few examples, and there's plenty more. So I want to do another quick survey of the room. So do you know the value of your business assets? I'm going to activate this poll for you over here. It's a two-part. I'll activate both of them. So do you know the value of your business assets? It looks like, I'm not sure, maybe these polls are already visible, but go ahead and weigh in on those two. Do you know the value of your business assets? And do you know the value of your business's liabilities? And while you're doing that, I also want to just introduce Caroline Nelson, who's in the chat room, and she's my boss. She's on our loan team as well. She's our Chief Operating Officer, and she's going to be sharing a lot of information with you guys in the chat window. So she might ask some questions or just share links with you and that kind of thing. All right. So, okay, some yeses, some nos. Liabilities, interestingly, more people understand their liabilities than their assets. You got to stay on top of those. So that sort of makes sense. Okay, all right. So the next question is, how much is your business worth? And I think Caroline's going to pop this into the question section. So if you look under Ask a Question, if you pull that tab up, and anyone can do this throughout the presentation. If you have a question, and these are things that that maybe a question for Betty or Danny, if you have a specific question, you can throw it in here. So Caroline is asking, you can see what affects a business's net worth. And if you want to comment on that, you can click the little comment button, or you can just answer in the chat window. But do you know how much your business is worth, or generally speaking, what affects a business's net worth? So I'll give folks a minute to answer that question. And maybe if you don't know the answer, that's why you're here, because we're here to answer that question. All right, well, as it turns out, there's a very simple formula to answer what your net worth is. So you start with your assets, the things you own that will earn you money, and then you subtract your liabilities, the things that you owe, and that equals your net worth. So it's a very simple formula. For me, it's fairly intuitive. Just what you own minus what you owe is what your business is worth. There's another term that we use also called owner's equity. And this term it's a little less intuitive, but if you own a house, you may have heard the term before, and it's basically the same idea. You take the value of the house minus all of the obligations against it, and what you're left with is your equity in the house. So it's the same with your business. That would be owner's equity. So I'll use those two terms interchangeably. But just wanted to give you a sense that you may hear the term net worth, you may hear the term owner's equity. So for me, this formula is fairly easy to wrap my brain around. It's logical. What we do though, and this is actually how they use the formula, this is the balance sheet equation. This is the formula that they use in Europe. But in the United States, we've made one slight adjustment to this formula. What we've done is we've just added liabilities to the other side. So what that results in is assets equals liabilities plus net worth. So that is a little less intuitive for me, like the idea of liabilities and net worth going together doesn't quite make sense to me. It doesn't have any intuitive meaning to me, but there is actually a good reason why we move the equation around in that sense, and I'll get into that later in the presentation. But just so you know, the formula can be written either way. So just like last week, I would like to use an example. And so we're going to stick with the same example of our lemonade stand. So last week we talked about, you've been making lemonade since you were a kid. You make a mean, fresh squeezed lemonade. And so we did a lesson last week on, what your profit and loss might look like. Now we're going to look at your assets and your liabilities. So let's say in this tiny little business that you've got your lemonade stand, your nice pink and yellow lemonade stand. So let's start going through your assets. So let's say that you have a bank account with $250. You have inventory, so you maybe have cups and napkins and that kind of thing, $100 worth. You have the stand itself, which is a nice stand, $500 is what you bought it for. And then maybe you have like a nice juicer, $150. So altogether, that's $1,000. And let's look at the liabilities. It's a small business, but you do have a couple. So let's say you have accounts payable. Maybe you haven't paid your lemon supplier just yet. You're on an invoicing plan with them. So let's say you owe $110. And then if you recall the example last week, if you were on the call, we had 2 employees who were each got paid $40. And let's just say one of them hasn't cashed their check yet. So you have a wages payable sitting out there that you're aware of $40. So that comes out to $150. So all we need to do now is just plug those big numbers into our equation. So we have our assets at $1,000. We're going to subtract our liabilities of $150, and that gives us a net worth of $850. Pretty simple math. Again, just to put it in the US format, we would write it as assets of $1,000 equal liabilities of $150 plus net worth of $850. So now let's say that you have, you've been doing this business for a while, your lemonade business. You've gotten to know the community of lemonade juicers in town, and you learn that a couple of them are getting near retirement, and they actually offer you a free lemonade stand. So there's 2 of them. They're both offering you to just take over their business. They'll just give you everything, hand the business right over to you. So let's say the first lemonade stand is this nice little trailer that you can tow behind your car, and it has a value of $1,500. And the second one is this pretty sweet, tricked out, like VW van that's been converted into a lemonade stand. And that is worth $30,000. So I'm gonna activate this poll over here. Just wanna hear from you guys. Which of these 2 free lemonade businesses would you take? So go ahead and over to the poll section, and I wanna see where you guys are landing on this. Danny wants the van. That's not surprising. So I'll give you guys a minute. Okay, we're getting some mixed results. People are into the van. Oh, okay, we've got a modest taker on the lemonade stand. Oh man, the van is winning somewhat in a landslide. Okay, well, now let's say, sorry, I need to move this little thing out of the way because it gets in the way of some of these questions. So, okay, so for me, I would say the answer depends, and I'll explain why. So I told you the value of the assets, but what I didn't tell you was the liabilities. So again, let me get this thing out of the way here. So let's go through the full picture. So the lemonade stand number 1 has $200 in liabilities, not bad. So the net worth is $1,300. Now you come to learn that the lemonade van has $35,000 in liabilities, which actually gives it a net worth of negative $5,000. So you might still feel like that's worth it. For me, I would say, well, basically in giving me this van, you're giving me $5,000 in debt. I'm not sure that that's actually a great deal. So, again, there are other factors, but just purely in terms of the net worth of the business, the negative 5,000 is you have to really look at both the assets and the liabilities in order to understand the net worth. Okay, and Danny is pointing out, I can hide this. Thank you, Danny. That was very helpful. All right, okay, so let's say that you know, you take whichever the van is. I'll leave it up to you guys, but you have now been in business for a while. You're doing really well, and you're ready to take the next step up. So you're shopping around for the next business that you kind of want to take over. So let's look at these two businesses. We are going to look at their assets, both $50,000, and I know you're already looking at that van on the right with that sweet lemon on top. And if the last poll was any indication, I know what direction you guys are going to go. But the liabilities are similar, $40,000, which means the net worth is $10,000. So maybe just in the chat window, let's hear from you guys. Which of these do you want to buy? You know, you're actually going to have to put cash forward for one of these businesses. Do you, based on this information, do you have a sense of which one you would want to buy? Danny loves shiny things, so we already know what he's voting for. So I'll just let anyone weigh in if they have thoughts. Do we have enough information? Melissa's asking if maintenance is a liability. It's not a liability unless that would go on the balance sheet, unless it's something that maintenance is something that would be a cost of doing business on your profit and loss statement. So it's just an ordinary business expense. So that might affect your profitability. So that's something to consider. And you're kind of getting into something, Melissa, which is that, you know, in addition to the balance sheet, you're also going to want to look at, you know, the profit and loss and some more of the numbers. So the balance sheet gives you some information, maybe not all that you want. Kara still wants the van, the lemon on top. Okay, so the reason I bring this up is just looking at these two pieces of information, we can't really make a decision. Obviously, the lemon would be the deciding factor, but just based on the numbers, we don't really know. So I want to introduce, we're going to have to do a little bit of a deeper dive on assets and liabilities to really understand what's going on here. So let's go ahead and do that. And the main way that we break these down is we talk about current assets and we talk about fixed assets. So current assets are anything, cash and anything that you expect to turn into cash within 1 year. Fixed assets are these longer term items that have a longer life and you're not probably going to turn them into cash anytime soon. So just to give you an example of what some of these might look like on the balance sheet. So current assets would be cash equivalents like checks that you haven't deposited. Accounts receivable, you expect to get those pretty soon. Inventory, you're hoping to sell, turn into a product or sell as is fairly soon. Fixed assets, we talked about some of them already. They might be real estate, property, they might be equipment or machinery, vehicles, those types of things that serve your business, but you're not selling them. That's not really the goal, is to turn them directly into cash. And similarly for liabilities, we have our current liabilities. So that's your debt or obligations that are due within 1 year. Sometimes people talk about a normal operating cycle, which could be, in your business might be slightly different than a year, but a year is kind of the standard if you don't know. And then there's your long-term liabilities, which are debts or obligations due more than a year from now. And to give you a few examples, there's a lot of these as well. We talked about some of them: accounts payable, customer prepayments, business credit card debt. You know, you're supposed to be paying that down as you go. The salaries and wages, you know, it's just a matter of time before those checks get cashed. This is probably the most confusing one, the current portion of long-term debt. And so what we mean when we say that is if you've taken out a loan, you know, like on a building or a vehicle, maybe it's a 5 or a 10-year loan, we want to know what portion of that is due within the next 12 months. And that's the principal portion, by the way. We did talk a little bit about interest. Your interest expense. Interest isn't something that has any value to you. So you're only looking at the principal, which is going towards, you know, that asset, building your assets. And then you might have some income taxes payable. Long-term debt, there are other examples. They're not as common, the long-term liabilities, but debt is probably the biggest one, a mortgage or a car loan or a loan on a piece of equipment. And then you might have some deferred taxes that you're waiting till next year to pay or something like that. So with that in mind, looking at these two businesses, let's really dig into the assets and the liabilities. So let's look at the first one, Lemonade Truck A. So, okay, we have $16,000 in cash, we have $1,000 in inventory, we have $3,000 in accounts receivable, and we have that nice truck, which is worth $30,000. And so that all adds up to $50,000. Our liabilities, remember, are adding up to $40,000. And if you look at the details, we have accounts payable of $10,000. We have the current portion of the long-term debt is $5,000. And the long-term debt is $25,000. So it looks like that truck was probably bought, you know, with a loan of $30,000, and $5,000 of that is due this coming year. All right, looking at our next Lemonade truck. So this one, he has less cash, $8,000, same inventory, a little less that he's expecting in receivables. And then we have that truck plus the cool sign that was maybe a custom edition. So that is worth, you know, what he paid was probably a little more, let's say $40,000. So that still adds up to 50. And then we have our liabilities. Accounts payable is $5,000. Current portion of debt is a little higher, $10,000. Maybe he got, you know, a more aggressive loan or a higher interest loan or something like that. And the long-term debt is still $25,000. So that adds up to 40. So my question to you then is, does this change your mind for anyone? So I'll just give you a second. Is anyone seeing anything in here that would tip the balance for you in one way or another? So I'll wait one moment, see if anyone has any bright ideas. And I'm also going to look at the questions. So Uday was asking if lemons are perishables, are they assets or liabilities? They are assets. So, you know, you may have a cost of, you may have a waste cost that is just a normal operating expense. But the assets, that the lemons themselves are assets because they're part of the product that you will sell. Okay, so Devin is saying truck A has more cash and receivables, and I don't think that lemon sign will make more money. So that's a good point. I'm just going to highlight. So we got a couple folks talking about the cash, and cash is nice. So I just want to highlight a few things here. So what I've done is I've turned these yellow. And so ordinarily on a balance sheet, this will be easier to see. But what I've done is I've highlighted everything that's current, whether it's an asset or a liability. And we're just going to focus on those for a second. So let's do the math on Lemonade Truck A. If you add up the current assets, they add up to $20,000. If you add up the current liabilities, they add up to $15,000. So we're in pretty good shape there. Let's look at Lemonade Truck B. Our current assets are adding up to $11,000, whereas our liabilities are adding up to $15,000. So that is maybe not a good position to be in. That's something that the fancy term for it is your current ratio. If you divide your current assets by your current liabilities, you want to see that you have more current assets than current liabilities. And the basic reason for that is, you know, if you've got a bunch of debt coming up in the next 12 months and you don't have enough on hand to pay it, then you're going to be in trouble. So I know I think I need to redo this presentation because I'm just a killjoy. No VW vans, no lemonade trucks with lemons on them. So I'll rethink that. But just wanted to use that as an example for how you really do need to get into the details around the assets and the liabilities if you really want to understand what you're getting into. Okay, are there questions so far? There was the question in here about lemons, perishables, and just to repeat on that. So the lemons are an asset because they're part of, you know, what's going to help earn you money. And you would ordinarily just have an ongoing expense of waste. So yeah, be thinking about questions. And I would say if you have clarifying questions as I am going, just throw them into the chat window because I'm more likely to see them. And then if you have bigger questions, throw them into the ask a question area. And so Danny's asking about cash versus a fixed asset. What do I think about it? I'm gonna let you answer that, Danny, when you get on here in a minute. That sounds like a great one. Okay. Okay, so we have our lemonade business. This truck seems like a pretty good contender. Again, we know there's $50,000 in assets. And how that broke down was current assets of 20,000 with fixed assets of 30,000. We know our liabilities are 40,000 and they broke down in terms of current 15, long-term 25. And we know that gave us a total net worth of $10,000. Now let's say we find another business that is almost identical. You know, the truck the truck is almost the same except maybe the color. But you look at the balance sheet and you're seeing exactly the same numbers. So my question then for you guys would be, which one should you buy? And the answer here, I'm not going to waste too much time. The answer here is that there's really no way to know just with this information that we've been given. So you might guess that we're missing some information over here on the right, the total net worth. Maybe we need to know a little bit more about net worth in order to make this decision. So I'm going to ask you guys a question, and I think Caroline's going to pose this. What affects a business's net worth? So how would you increase the value of your business or possibly decrease the value of your business? And if you run a business, you probably have some ideas. How do you add value to your business? How do you increase the net worth? Any thoughts? Earn more cash, so you have more cash. I mean, certainly earning more cash. That's certainly part of it. So I'll just go ahead and kind of go through the ways that you can increase. Yeah, so pay down your debts. That's basically you're wanting to decrease your liabilities or increase your assets. But I guess what I'm looking for here, the first and best answer that I like, if you want to increase the net worth of your business, then I would say start plucking money from the magic money tree. Wouldn't that be great? You know, if you had something like that, we'd all be in great shape. Obviously, that's not an option. So the basic answer is you can start earning more profit. And as you earn more profit, you get, like Danny said, you get more cash, or you can turn that cash into assets. Another way that you could increase it is people could just literally give you money. I mean, this is kind of how things work in the real world. If you know, even if you just have a job, you can work harder and get a better paying job, or you can get people to give you things, give you money or give you things. So it's the same for your business. And yeah, so decreasing expenses is a way basically to increase your profit. If you're looking to decrease the value of your business, I don't know why anyone would, but you could start losing money. So we talked about the profit and loss. If instead of earning a profit, if you're incurring a loss, that decreases the value. It decreases the amount of cash you might have. And then also you could just start giving money away. And that might sound silly, but that's essentially how businesses operate, is they give the money that they earn away to the owners. Basically, the owner is going to take a draw out of the business. So these are fairly basic and probably more complicated. You probably thought I was looking for a more complicated answer. So I just wanted to highlight those because those answers actually all relate to the owner's equity section of the balance sheet. So if we break it down, we had our business earning more profit or losing money. And that corresponds with two subsections of owner's equity, and they would be net profit and retained earnings. And I'll explain the difference between those here in a minute, but basically it's the profit that you're earning through the business. The next one would be just literally people giving you money or giving the business money. Most often it's going to be an owner, or it might be an investor or partner, something like that. So you're contributing things to the business. It could be cash or it could be non-cash. You're contributing a vehicle, tools, etc., and transferring them to the business. And then the last one, giving away money, most commonly comes in the form of a drawdown by an owner, and that's basically just taking money out of the business, and that's always going to be negative. You're subtracting money out from the business. So that's what owner's equity looks like. I did just want to clarify real briefly the net profit versus retained earnings, the distinction. So the net profit is the net profit from the most recent period. And if you were in the lesson last week on profit and loss, we talked about how to do a profit and loss statement, and that very bottom line was the net profit. And so that is what's going to go on your net profit, in your net profit section of owner's equity. Meanwhile, retained earnings is all of your prior net profit from previous periods. So I'll give you an example of what that might look like. Let's look at a company. They've just completed 4 years of business, and in their first 3 years, they averaged $50,000 of net profit. And then in their fourth year, they earned a net profit of $60,000. So the net profit would be $60,000, and the retained earnings would be 50,000 times 3, those first 3 years, for a total of $150,000. Now let's say we've got the same company and we're looking at them a year later. So they've done 5 years of business. So in year 5, they have a net profit of $75,000. So the way that would break down is, again, the net profit is just the net profit from that year, $75,000. The retained earnings is going to be everything from before. So the $60,000 plus the $150,000 gives us an answer of $210,000. So that's just kind of a nice way to break things down on the balance sheet, because you're able to see, both what has happened most recently and then historically what the company has earned over time. So just to summarize, we break this down because it helps us see that profitability over time. It also helps us see the owner's personal investment in the company. Again, that would be through the contributions section. And then we can see how the owners are using their earnings and if they're drawing money out of the business, which is a totally fine thing to do. Obviously, that's why you run a business. But if you're starting to see like, oh, they're drawing more money out than they're earning, then you start to wonder, okay, well, where is that money coming from? Are they taking on debt, et cetera? So that net worth, again, is the same on both of these. Again, we were looking at these two businesses, A and B, where everything looked almost exactly the same, but that net worth was still a little bit of a mystery to us. So let's go through now and look at, really break down the net worth of the owner's equity. So let's say these are two businesses. They're competing lemonade stands. You're thinking of buying one. They've both been operating for 4 years, and the owner works roughly half-time. So that's just a little background to know about them. So breaking down the first one, again, we know the net worth is $10,000 for both of them. So let's look at the first one. Net profit last year was $2,000. The retained earnings are $5,000. So that's the amount of money they would have earned in the first 3 years. The owner contribution is $10,000. And the drawdowns are $7,000. So that all adds up. You've got 7, 17, minus 7. That's how you get to the 10,000. Business B, net profit most recently was $25,000. Their retained earnings over the first 3 years were $75,000. And the owner contributions are the same. They put in about $10,000. And they were able to draw down $100,000. So 25 plus 75 plus 10, so that gives us 110 minus 100. So we still get to the same net amount of $10,000. So my question then, and maybe it becomes obvious at this point, which business would you want looking at the details of the net worth of the business? To me, it's pretty clear that you would want to buy the business that has historically been earning profit, most recently and historically. You know, they didn't put a ton into it, they put some into it, but they've really been earning a lot of money and able to, you know, half time earning, you know, roughly $25,000 a year. That's pretty good. Over here, you're working half time, you're only earning, you know, $1,500, $2,000 a year. So this business has obviously figured out a more profitable model and how to do their business. So that's just to give you a sense of why it's important to really dig into the details of what you see under the owner's equity. So that was a lot. So I'm just going to summarize for you that the balance sheet, what we've learned so far is that, again, it gives you a snapshot of a company at a particular moment. It helps you determine the net worth of the business. It compares what the company owns and what the company owes. And it shows trends over time. And the way it does that really is through the retained earnings. You know, it is a snapshot in a moment in time, but it really tells the whole story of the life of the business, because it's from the very moment that the business started, how much has it been able to earn, how much has the owner contributed over that amount of time. So just with one balance sheet, you can see a lot of that. And then if you're able to get your hands on a balance sheet for each period or each year, then you can dig into it even more and see what kind of, how things have shifted over time. So again, just a reminder that you really want to dig into those details. It was nice to think with those nice shiny things, the assets, that we wanted a business, and then maybe took a step back after looking at the details. And then it can help you get financing. And I'll address that in the next section because I haven't really touched on that. Just want to pause for a moment and see if there are any burning questions that folks have. I'll look in the question area. We still have Danny's question that I'll save for him, punt back to him when he gets on. I'm assuming that you guys are following if there are no questions. But I'm actually going to test that now. So last week we did this as well. We talked about Caroline's saying you asked a question. I thought that I answered that about the lemons. The lemons are an asset. The lemons themselves are an asset. You would pay an expense if those lemons were to rot. Then that would be an expense on your profit and loss statement, just an operating expense. So we're going to turn to this example that we used last week. We have a sample business. They're called All Things Fermented. And this is a small-time food manufacturer. They produce fermented foods, namely kimchi and sauerkraut. They sell mainly wholesale and online, and then they go to the farmer's market every week. And then this is a new piece of information. They've been in business for 3 years. So we are going to go through a little bit of a Q&A with this sample business, looking at their balance sheet. So I'll just throw that up here real quick. This is what their balance sheet looks like. And I just want to point out that you won't always see a balance sheet structured this way. We did it this way, where you have the assets on the left side of the equation and the liabilities and the owner's equity on the right side. So we just wanted to do it in a way that sort of aligns with the actual equation. It also fits on the page, which is convenient, but more often than not, you're going to see assets, liabilities underneath, and owner's equity underneath that, just one single column. So I'm going to ask questions, and then I'm going to bring this balance sheet back to you so you don't have to memorize it or anything. So the first question is, what time period is covered on the balance sheet? So I'm going to bring that back up. You can see the question. I've placed that in here in case you forget, here on the left. So maybe you guys can just type into the chat window, what time period are we looking at here? Give a moment. There are a lot of numbers here. If you were on the P&L lesson last week, you know to start at the top. So you've got the name of the business, you've got what it is, and Aldina got it. It's December 31st, 2019. And I just want to point out, Danny, yes, thank you. It's a date, not a time period. So good, good catch on that. So again, different from the P&L, which covers a whole time period. This is a specific moment in time. So your balance sheet is always going to have a single date on it. It's not going to be a time period. So I misled you with that question, sort of intentionally, and you guys caught it. Is the balance sheet balanced? So I actually cut off the totals in this view, so you can't see the answer quite as quickly. But I'm just going to highlight the numbers for you. So we have our assets, we have our current and our fixed, and that adds up to $13,600. We have our liabilities total and our total owner's equity, $4,550 plus $9,050, and that seems like it adds up to $13,600. So yes, we are balanced. That's always the first thing you want to make sure of on your balance sheet, is that you are actually balanced. Okay, so I mentioned this in passing, the current ratio. So I'll just, since it's not fair, I didn't actually give you the formula. I'm going to give you the formula here. So the current ratio is the current assets divided by the current liabilities. So I'll give you folks a moment. I'm actually just going to highlight the two numbers here in a moment, but I'll give you a moment to look and see if you can find the current assets and see if you can find the current liabilities on the balance sheet. And then all you would do is divide the first one by the second one. So if you haven't found them, they are here. Current assets and current liabilities. And I'll do the math for you. You're taking 3,600 and dividing by 2,250. And you end up with a current ratio of 1.6. And the current ratio is, you could just subtract, and you could say, you want your assets to be bigger than your current assets to be bigger than your current liabilities. Or you could divide them, and basically you want to see a current ratio that's greater than 1. As long as this current assets number is greater than your current liabilities number, then your current ratio will be greater than 1. If it's less than 1, the reverse is true, and that means you're in trouble. Your current liabilities are greater than your current assets. All right, question 4. So again, All Things Fermented has been in operation for 3 years. So did All Things Fermented earn more in its first 2 years on average, or in its most recent year? So this should be something we can figure out looking at the balance sheet. So we're going to have to find this is probably going to be in the owner's equity section, right? Because we're talking about our earnings. So let's go ahead and look down there. So we have our retained earnings of $750. And again, that was over 2 years. So I actually think I did the math wrong. I'm just realizing that should be 375. My apologies. And then we have our net profit from the most recent year, and that's $477.20. So the answer, just in looking at the balance sheet, is that our most recent year was more profitable. So that's good. We're on an upward trajectory. Okay, question 5. Now this is a little bit of a tricky one. Does the net profit on the balance sheet align with the profit and loss statement? And I haven't shown you the profit and loss statement. If you were on the lesson for profit and loss, this is the same company. So you would have seen it last week, but I'll go ahead and show you both. So we want to see whether the two are aligning. Again, I said the net profit should align. The net profit that you're getting on your profit and loss statement should show up on the balance sheet. So let's go ahead and note the date. We did that already. So it's December 31st, 2019. And now we want to find the net profit, and we just were looking at that. So it's $477.20. So now we want to look at the profit and loss statement. So I will throw that up for you. And if you were on the call last week, this may look familiar. So we're going to do the same thing. We're going to note the time period is January 1 through December 31 of 2019. And the net profit is $477.20. So the answer then is yes. Now, in the case of the balance sheet, we're just looking to see that it's that the date on the balance sheet aligns with the last day of the profit and loss statement. So that was December 31st, 2019 on both. And indeed, that $477.20 shows up there. Yes, and thank you, Caroline. She's pointing out the link to the lesson from last week. Now, this question is not really one I would expect you to be able to answer, except maybe Caroline, who's on the lending team. But what do you think a lender might focus on in all things Fermented's balance sheet? And we want to ask you this question just so you know, if you're applying for financing, you're probably going to have a conversation with the lender, and they're going to ask you a few questions. And so it's good for you to kind of be prepared for what's coming. So there's any number of things that a lender might look at, and I'll just go ahead and answer the question. The first and most basic thing is we would look at all of the assets and all of the liabilities. And so the assets, we're sort of looking at like, could these be used as collateral? And so if you're not familiar with that term, that's basically when you take out a loan, collateral is what you're using to guarantee the loan. If you can't pay it off, you can give X, Y, Z as a backup for not being able to pay. And so you might see, like something that we see a lot is like leasehold improvements. And so those are improvements, maybe you don't own your building, but you've made improvements to it. And so that could go on the balance sheet, but that's not something that that you can just give to the lender as collateral. So we're just kind of gonna dig into what exactly the assets look like and ask you questions about that. And similarly with the liabilities, we're probably gonna be asking like, oh, I see you have business credit card debt, or I see you have this big loan. What's that for? Is that a building? What is your monthly payments? So not all of that will appear on here, but it will give us a sense of kind of what to ask you to understand what your debts and liabilities are on a monthly basis. Another thing is, again, the historic profitability. So we'll look at, how long have you been in business and what have your earnings looked like over that time period. Another big one is we're going to look at your contributions. We generally, especially for younger businesses, we like to see that the owner has put something into the business, put their own money or assets into the business, because that makes it less likely for them to just walk away. And then finally, we'll look at, the question we just had, does the net profit align with the number on the profit and loss statement? And this just basically gives us a sense of, how legitimate are these documents? Does the person who's putting them together know what they're doing? And sadly, a lot of times the businesses we work with have a bookkeeper, and even after all that, the numbers still don't align. So Betty mentioned last week, there's not a lot of options for bookkeepers in Tucson. So we're hoping to help you think about, if you're preparing your own books, what sorts of things to watch out for. Okay, I'm gonna check real quick. I see a couple questions popping up. Oh, yes, so thank you. Someone asked whether there's a link to the profit and loss statement lesson, and Caroline shared that in the chat, so thank you. All right, so now that we've gone through that, I want to do the same thing that we did last week and just sort of acknowledge that's all great, but you probably are wondering what you should actually do now. So I'll start with the same basic advice. Quickly, you want to establish a business bank account if you haven't already, and you want to start separating your business from your personal. Otherwise, it's just really hard to understand, is your business profitable? What actually does your business own versus what do you own? Those types of things. And then you're going to start organizing your data. And here, we talked about this last week as well. We talked about the chart of accounts. And that's just basically a fancy term for the categories that we're going to have under assets. So I would say take a look at your assets, the ones that your business owns. Start dividing them into buckets or categories. And I'll just give you an example of what that might look like. We've already seen them, but you probably are going to have cash, hopefully. At some point you'll have cash. You may have accounts receivable. You'll have maybe some type of equipment or real estate, inventory, vehicles. These are all categories that you might see on your balance sheet. And then the next thing you're going to do, again, we talked about this, is divide into current versus fixed. So you'll just go through, and again, current means something that's cash or you expect to turn into cash within 12 months, and fixed is that you're not expecting to turn into cash within the next 12 months, but still is helping you earn money. So these are fairly easy. Equipment is not current, it's probably fixed. Real estate is fixed. Inventory is current. Vehicles are fixed. And that's basically it. That is your chart of accounts for assets. So I don't mean to confuse you. I just want to use that term, chart of accounts, because you're going to see it. You're going to hear your bookkeeper talk about it if you have one. If you use loan software, et cetera, they're going to talk about the chart of accounts. And all they mean is just the particular set of categories or accounts that you break your items down into. And the same was true for your profit and loss. We talked about all those expenses. Those categories are part of your chart of accounts. You're going to do the same thing for your liabilities now. So start looking through them and dividing them up. And so you'll probably, these are typical ones: accounts payable, customer prepayments, gift cards, long-term debt, wages payable, current portion of long-term debt. And again, you'll break into current versus long-term. And the current ones are more common. Again, the only one on this list of examples I gave you that's long-term is just long-term debt. So, some of those bigger loans that you might have that take multiple years to pay off. So now you have your chart of accounts. Once you've gone through that more comprehensively, you'll have your chart of accounts. Same for equity. And these, I would just encourage you to use this list right here. Contributions, you could divide it into cash versus non-cash if you want. A net profit, or retained earnings, and an owner's draw. That's probably about it in terms of what you would see. Okay, so again, similar. There's always multiple ways to organize your data, and for some, the easiest way is going to be with just paper and pencil and calculator. Some of you are more familiar with spreadsheets, or you want someone to do the math for you, so that's another option. And then I'll get into this a little bit too in terms of some accounting software. There's desktop and there are online solutions, and Wave and QuickBooks are just a couple examples. So it turns out that doing what you would actually do in this case, if you're using paper or a spreadsheet, is probably going to look pretty similar. So I've just grouped those together. And again, the first step is going to be to create your categories or your chart of accounts for your assets and your liabilities. Then you're going to take inventory. And this is something where if you don't have a lot of inventory, you probably don't even need to bother with this. But you're going to go through, if you really want to prepare your balance sheet properly, you need to know, well, how much inventory do I have on hand in this moment, and how much did I pay for that? So you should go through and look at inventory. And then you're going to look through those assets and liabilities and figure out the value of those. And I would just point out that you want to use the purchase value. So if you bought that vehicle for $20,000, that's the number that you're going to use. And we're not going to get into depreciation today. Depreciation is something that would show up, that you may want to take into account and you might see on the balance sheet, but we're not going to do that. So Melissa's asking a question about inventory versus COGS, and that is a confusing question. I'll see if I can answer it briefly. So when you purchase items that you're going to sell, technically, like let's say you spend $150 on the lemons and the sugar and the napkins. You go and you do an event and you sell $150 worth. So technically, the $100 is only the good that you sold. That's the cost of the actual goods that you sold, is that $100. So only after you sell those items would you put those on your profit and loss statement. The remaining $50 is part of your inventory. So if you're actually preparing your statements at that time, you would say, okay, well, I spent $100 on cost of goods sold. Those are the items that I actually sold. And so the $100 goes on the profit and loss. I still have this $50 worth of inventory. That's going to go on the balance sheet. So hopefully that answers your question, Melissa. But that is confusing, and it starts to get into, okay, which goes where, profit and loss versus balance sheet. And that is one of the more confusing points. But just to reiterate, COGS only goes on there on the profit and loss statement after you've actually sold the items. Okay, returning to this, you're going to take your current portion. You're going to figure that out. Like if you have a longer term loan, you're going to deduct out like, okay, well, what is the portion that I need to pay on the principal in this next 12 months? So that'll go in your current section. And then you're just going to create your balance sheet and start entering the data. So that's basically it. Now, there's a simple version. If all you want to do is just look at assets and liabilities, then you can prepare a very simple balance sheet and just ignore all of that stuff that I told you about the owner's equity section. Just do assets minus liabilities, and there you have your total equity. So I'll give you an example of what that could look like. So in our lemonade truck business, again, we had our assets over here of $50,000. We had our liabilities on the right of $40,000. And then we know the difference between the two is $10,000. So that just goes into your owner's equity. And that's fine. Again, it doesn't answer some of those other questions under owner's equity. So, depending on who's looking at it, they might want to see that section, but this is the most basic form of a balance sheet that you can do, is just assets minus liabilities equals total owner's equity. So we have this, you can write this out yourself, but we have a Word version of a balance sheet that gives you tips, little explanations on the side, and just walks you through exactly what to add together, what to subtract. And Caroline just shared the link to this. So you can go ahead and download that for your own use. And it is, you can't fill it out online. You're going to need to download it. And so that's the basic one. Now, if you want to actually fill out the owner equity section or the net worth section, then you're just going to go through these categories and start filling in the numbers. So how much have you contributed as an owner, either cash or non-cash? What was your most recent net profit? What were your retained earnings in all of the periods prior to this most recent one? Add those up. And then how much have you drawn out of the business? And once you put that in, again, this is the same balance sheet. And this is the example that we used before. The owner contributed $10,000. They had a net profit most recently of $25,000, retained earnings of $75,000. They've drawn down 100, and that all adds up to 10,000. So in theory, those two sides should balance with each other. They should add up together. Now, a common thing that you might run into, thank you, Uday, for being here, is your balance sheet is not balancing. Womp womp. So we have some tips on what to do if your balance sheet isn't balancing, because it can be very frustrating. If you've gone in and you've filled out that equity section and you're like, hey, this isn't adding up, here's what we would recommend. So remember that your total equity is assets minus liabilities. So I'll walk through this, but I'm going to give you an example too, because this might get a little confusing. So you've added up your net, your owner equity, all of those different subcategories, and you also have your total equity, assets minus liabilities. So if those two numbers aren't adding up, then you can figure out how much you're off by. And then you need to increase your owner equity section by either upping your owner contribution. Maybe there's more assets that you contributed to the business or cash that you didn't realize. So think back on that. Or maybe you earned more money than you thought, or less. So you might have to increase or decrease these numbers to get yourself back in balance. Or you would do the opposite to the owner's draw. So maybe you actually took more money out of the business than you thought. So I'll give you an example. This is that same balance sheet, but now something has happened and we're off. So we now have our total assets are $49,000, but our total liability and equity is $24,000. So these two numbers should be the same here on the bottom. And it looks like we're off by $25,000. So I'm actually going to open Excel and play with this so that you can see the math happening in real time. Let me zoom in a little so you can see it a little better. Okay, so we know that we're off by $25,000. And so maybe it's a matter of, you know what, actually my retained earnings should be $75,000. I'm $25,000 short. So suddenly you're back in balance. Or maybe you're realizing, and this is probably more likely, you know, I didn't actually take $100,000 out of the business. It was probably negative, it's always a negative $75,000. So that's what I mean by going the opposite direction. So you're gonna have to come up with that extra bit. And this is a little weird. This is, I'm telling you because you're probably in a boat where you've never done this before and you're not gonna have good numbers. So I'm not saying just make things up, but I'm saying think a little more about like what probably actually happened here, because the money did go somewhere. So that's what you have to do. I also want to point out that we have tips in this template, and Caroline can share this with you. But if you look at down here, we let you know. So let's go back to our original numbers. So we're out of balance, and we've created this tab over here at the bottom called Tips for Balancing. And here, you know, we've got some general tips. I'll zoom in here a little bit for you. So we have some general tips, but then this section, if you're out of balance, this section will pop up and tell you exactly what needs to happen. So it's saying here, you know, we've got a difference, you're off by $25,000. And so you either need to increase your equity, most likely the owner contribution or the retained earnings, or decrease your owner's draw. So, and if you were to go the other direction, it's going to update and say, now you're off $50,000, but you need to decrease your equity or increase your owner's draw. So it'll give you the numbers and just kind of coach you through the process of making sure that your balance sheet is actually balanced. All right. And then, so let's say you've done your balance sheet and you are in balance. And then the next problem you're probably going to face is, how do you actually stay in balance? Once you get balanced, how do you stay balanced? And so I'm going to run you through some examples here. So let's say, you know, you did your balance sheet. Let's say that you were able to add a piece of equipment to your business and that it costs $10,000. Okay, I may have shared the wrong template, so I'll get you the right one before the presentation is over. I apologize for that. Okay, so we have our $10,000. So again, now instead of $30,000 in property, equipment, and vehicles, we're at $40,000. So we've added $10,000 to the balance sheet. Updating, so our fixed assets are now $40,000, our total assets are $60,000, and now we are out of balance because we have 60 down here on the left and we have 50 down here on the right. Okay, so the way to fix this, there's any number of ways to fix this, and the way to fix it is to really say, well, how did I acquire that item? And let's say, just for an example, that you as the owner just bought that piece of equipment out of your own money and you contributed you contributed it to the business. So that would go under, and that would mean that you need to update your contributions by owners. So that's this section under owner equity. So instead of $10,000, you're adding $10,000 to the right side. So that updates to $20,000. Your total equity updates to $20,000. And now you're back in balance with $60,000 on each side. So that's one example. Another possibility is that you just bought that piece of equipment with a business credit card. So you can see your credit card line is 0. So let's add $10,000 to your business credit card debt. That updates your current liabilities to 25, your total liabilities to 50, and now you're back at 60,000 and you're balanced. So this is finally circling back to that original point I made about why it can be a little more intuitive to have your assets on one side and your liabilities and your equity on the other. The basic reason is if you come over here and you add something to the left side of the equation, then you're going to have to add something to the right side of the equation. So every time you make an update to your balance sheet, there's going to have to be 2 updates. And Melissa, I'll get to that question in a second about depreciation. And actually, that might be a good one for Betty. Another possibility is $10,000 rather than, so let's go through this again. You've added $10,000 to one side, and now you're out of balance. The other possibility is that you can deduct that $10,000 from the same side. So in this particular example, let's say that you purchased that piece of equipment, that $10,000 piece of equipment, just with your own cash out of your cash, your bank account. So instead of $16,000, you've spent $10,000, which brings you down to $6,000, and your current assets are reduced by $10,000, and your total assets are reduced. You're back to the original number, $50,000. So again, you added 10, but you also subtracted 10 from the same side, so you end up with that same original number. So those are just tips on how to keep your balance sheet in balance once you've gotten it balanced. So just to summarize, when you change one side of the balance sheet, it requires an additional change. So you can either change the opposite side by the same amount. You can change the same side by the reverse amount. So if it was $10,000, then maybe your cash was reduced by $10,000. Or you could actually do a combination of the two. Like say you bought a vehicle and you put $10,000 down, but you took out a $30,000 loan. So those add up to $40,000. So you have a new asset of $40,000, and you've made changes to both sides to equal it all out. I just want to, let me just check the questions. Okay, we still have Danny's question. I'm gonna just proceed here and get a little bit into the accounting software. And we talked about this now, whether to use accounting software is a big question, and there are pros and cons to both. And we talked about some last week. Some of them are the same in this case. There's no formulas, there's no math. In this case, there are protections so you don't get out of balance. So you can't actually screw it up. It's going to tell you, hey, you're making a change. You need to make a change somewhere else to stay in balance. Again, it can easily, you don't have to write any of this out by hand. You just click a button and you have your balance sheet or your profit and loss statement. And it's good at handling a large number of transactions. And again, if you're going to ever work with a bookkeeper, it's nice to have your information well organized. The cons, it costs money. There's a learning curve, and I think the balance sheet is even harder in some ways than the profit and loss. So I would just put a real word of caution out about that. And that initial setup can be tricky. And then finally, your data may be hard to extract. QuickBooks is, a good option. There's a bunch. QuickBooks, you're going to be able to extract your data and I know that you can export things in Excel and those types of things. So there are lots out there. We're not advocating for any particular one, but we do recommend these few. In particular, we recommend Wave and QuickBooks. So the reason for that, for me, Wave it's simple and it's easy and it's free. QuickBooks is the gold standard. So, those are the two that we've kind of played with. Again, Caroline can throw this link over to you guys, but there's a whole article that you can read through if you want to sort of assess the pros and cons of different ones. So, thank you, Caroline. So this looks similar to last week. Play around with the different solutions. Look what features they have, what the pricing is. Look at what kind of options they have. Is it desktop? Can you use it in a browser? Do they have an app for your phone? Again, the same basic step. You're going to go through and create your chart of accounts, your categories, this time for your balance sheet. So for your assets and your liabilities and your equity. Then you can import your credit card statements or link your bank accounts. And then this is where it gets a little bit tricky. If you've been in business for a while and you're just getting started now, you're probably going to have to start kind of rejiggering some things, adding some additional transactions or journal entries is when you're adjusting something that's already on the balance sheet to kind of make it all balanced. So I'll just run through Wave and how you might do that in Wave. And again, Wave, like I said, it's free. It has great invoicing and accounting. It's easy to learn, but it is a little newer and less well known. So a bookkeeper might wonder what you're doing if you're trying to hand over an account in Wave to them. So with that said, this is going to be, I'll show you this both to you in Wave and QuickBooks really briefly. It'll look similar no matter what software you use. So you're going to find your chart of accounts. In this case, we're looking at assets, and I'm just going to use an example here for you. You can see the list of assets, and what we want to do is we want to add a new account under assets. And in this case, like using our original example, let's say that we've acquired a lemonade stand or a trailer. And so once that next button pops up, we're going to just fill out these, what account type it is, it's equipment, and what you're going to call that account category. So maybe you have multiple stands or multiple trailers, so you're creating a whole account with that name. And now you can see that you've created it, that it shows up here under your list of assets. So you're basically just going to do that for your assets, your liabilities, and your equity. You're going to add all of the categories that we talked about and fill out your chart of accounts. So once you've done that, you can go in and you can start adding things to your business that maybe didn't show up. A lemonade stand is not going to show up when you import your bank data, right? So you're going to have to go in and add that manually. So the way you do it in Wave is you go to transactions, you click on more, and then there's one going to be called a journal entry. And then you start filling it out. So what is it that you're adding? It's a lemonade stand. When did you add it? And then this is the part where it can get a little confusing, but you're going to have to make a debit and a credit. And this is that same idea. When you add something to one side, you're going to have to make a change to the other side. So in this particular case, we're debiting the account, the lemonade stand account. So you add that, and you do the same for then you pick the account that you're crediting. So you're going to call that in this case, let's say it's an owner investment. It's a lemonade stand that you as the owner just contributed to the business way back when. So you would add that, and then you add the amount. And you can see here that once you add $15,000, you get a warning that says unbalanced. And so this is what I'm talking about. They're not going to let you save the transaction as is without also updating the other side of the balance sheet with $15,000. So once you save that, Then you can go over to your reports in Wave. You can select your balance sheet, and you can see here we now have a lemonade stand or trailer with $15,000 worth of equipment in there. So you'll just basically go through and you're going to use journal entries. I'll do the same thing for you here on QuickBooks. This is QuickBooks Online. Again, it's highly powerful. It's very well known. They have a bookkeeping support option, so you can actually hire someone to help you set up your chart of accounts. And then you can hire ongoing support bookkeepers to do ongoing support for you. And they have these resources. I think Caroline can share. We have this demo that I'm about to show you. They have stuff that you can play around with. The downsides are it's not free, and it's a little bit harder to learn. And again, that's just my own experience with it. Some people might find it easier or have a little more background in it. So what I'm about to do, Caroline just shared with you. This is a cool tool because it's not free. You can't just go in and start playing with it. QuickBooks has created a resource, basically just a fake business that's a demo account. And you can go in and you can literally just play with all the numbers, mess everything up as much as you want. And then, you know, everyone can do this. You're not seeing the changes that other people are making. It's just live on your computer. And then if you hit refresh, it all goes away. It reverts back to normal. So what we're going to do here is similar. We're going to go to our chart of accounts, which is under accounting. And you're just going to start adding all of the categories. So here, this is a sample landscaping business, so I did it a little differently. I went over here. I added machinery and equipment, and we're just going to call this equipment. Oh, I'm sorry, I meant to point that out. You click New under, when you're in the chart of accounts, if you click New, it'll bring up this page, and then you fill out the details that I just pointed out. So you would do that. You're also going to do it for equity. So you're creating an equity account. In this case, they call it a partner contribution. And then you might just call it a non-cash owner contribution. You have to put the date in when they want to start tracking that. And I think that has to do with the taxes. I'm not totally sure why. They'll also ask you what the account balance was the day before. So, you know, you might set this at the start date of your business. The day before your business started, there was nothing in it. So you'd put $0. So again, repeat that process for all your assets, your liabilities, and your equity. And then you'll go over to New. You'll create a journal entry, and you'll do the same thing. So you'll enter, in this case, I just gave an example, machinery and equipment. You select that account. We're going to call it $5,000. Maybe it's a riding lawnmower. And then if you try and save, you're going to get another error, similar to with Wave. They're telling you need to balance your debits and your credits. So you just go ahead and you add owner contribution, and it actually fills out these two for you based on what you had already added. And now you have a riding lawnmower on your balance sheet. If you go to reports, you can see the balance sheet. And down here at the bottom is a new piece of equipment, an equipment category that has $5,000 in it. So, and I didn't actually show it, but you would also see an owner contribution of $5,000 if you were to scroll down a little further. So that is a little bit about Wave and QuickBooks. And I think Caroline already shared this link with you. We just put together a quick resource guide on these two particular options. Again, we're not endorsing them. We have no relationship with them, but you know, there are pros and cons to both. So we encourage you to shop around and think about what the best option for you is. All right, so I think at this point, I'm going to invite Danny on, and I don't know if Betty is here yet. Betty, I might have missed you. If you're here, maybe just send us a quick chat. But I'm gonna bring Danny on. So give me a moment.
in it.
All right. Say something to us, Danny.
Hey, everyone. Can you guys hear me?
All right. Betty's here. Let me get Betty on. All right. All right. Hey, Betty.
Hi.
Thanks for coming on. Okay, I'm gonna take the presentation down and put us front and center. Okay. So, Danny, did you want to answer your own question? I'm not sure I totally understood it. That's why I'm punting. So
It was just, it was at the part when we were looking at different types of assets, and there is some complexity around when you're looking at, making choices between what's more valuable, and cash. Having more cash, sometimes there's more flexibility in having cash, and so there may be a higher value on that as an asset. And I can give you a quick example from us as a nonprofit. We take some of our idle cash, the money that we use to lend, and we actually have it invested in, say, the stock market. That's one of the things that we do. And when the stock market recently tanked and we needed money, it was hard for us to go and liquidate and take losses on this asset, and that asset had lost some of its value. And so in that case, cash can be really useful. Again, we keep money in the stock market because generally it does better for us than just having it sitting around on hand. But these are some of the complexities that go into that. Or, it's the same thing in some cases for people who may know, like owning a house. The idea of like a house is worth something and you may have equity in it, but tapping into the equity is not that easy. You either have to sell your house or you have to take out a loan. So there is the liquidity, basically how easily you can turn an asset into cash is just something important to understand as we're looking at. So sorry, that's sort of swinging back to way back in the beginning of the presentation, but that was sort of the point as we were talking about it.
Oh, that's helpful. Thank you. I think, Betty, do you want to take a stab at Melissa's question? Did you see that?
I did.
Where does okay.
And can you hear me?
I'm muting Danny and me because there's echo, but you go ahead.
So Melissa, on the depreciation, first off, they've changed a lot of the rules on depreciation, and so you need to work with your accountant and see what your depreciation level is. A lot of them have moved up to as high as $5,000 or $10,000, and so what that allows you to do is then when you purchase something, you're actually expensing it in the year that you bought it. But if you make a purchase that's larger and you are going to put it on your balance sheet, there are two offsetting entries. So on the balance sheet, you have the amortization, which decreases the amount of the value over the years, and then the depreciation falls down onto the P&L. And most people have a depreciation schedule, and they work with their accountant to get the depreciation schedule. So that's that. Nick, I did want to ask you, in terms of the balance sheet, if you discussed the credit card register before I hopped on. Did you talk about that at all? Or how the credit work? I think one of the things I see, one of the biggest mistakes I see small businesses making is not understanding how to use a business credit card on your balance sheet. A lot of clients will pay their credit card and post it to the credit card statement or the credit card account in your chart of accounts. But you have to do the other step of adding all of your expenses from your credit card statement into that register. So that's what ties your balance sheet, your credit card on the balance sheet back to your P&L. And you don't want to miss the expenses that you put on your credit card. So just listening to that, I think that's the most common mistake I see people make. using their balance sheet.
To return to Melissa's point, correct me if I'm wrong, Betty, but the depreciation, so like she said, that you need to have depreciation on your profit and loss. It's an expense. The amortization, I guess this is new to me actually. I think I've seen depreciation listed on balance sheets as well. But either way, it's going to be, sorry, I muted Betty, but she looks like she's agreeing. But either way, it would go as a negative on the asset side. Is that correct? Okay. So if you had, you know, $30,000 truck each year, you know, maybe you're taking 5,000 off or something like that. So you would add a negative 5,000 to the balance sheet. And that's also going to be a negative 5,000 that shows up on your profit and loss. And it's complicated to explain, but if you do all that, then you'll also see that the net profit gets reduced because it's showing up on your profit and loss statement, and that's how everything ends up staying in balance. So you have to do both, put it on your P&L and as a negative on your assets, and then the reduction in net profit will keep everything in balance. So does that make sense, Melissa? Clear as mud, possibly. I'm happy, I know Melissa too, so I'm happy to chat with you later if that's still confusing. What other questions do folks have? Clear as mud. This is, yeah, this is our chance to keep asking the bookkeeper and the business guru, like maybe how they use a balance sheet. I would ask you that, Danny. Can you comment on how you use the balance sheet?
So I actually wanted to, and sort of bring this up to everybody who's on here. We and Nick put together this presentation. Nick is not a CPA. Nick is self-taught. And we actually thought that that was important because this is not a training for CPAs. We're not getting into that much depth. This is a training for, you know, what I would call lay people, which includes myself. I think I have just a little more experience, you know, more time dealing with it than some of you may. But because these concepts, especially on the balance sheet, as Nick talked about, they aren't necessarily intuitive. We think in terms of profit and loss. We think of money in and money out. And I think that's a little easier concept in this idea of, you know, value of things and taking away the value and balancing out. It is definitely more complicated, but the presentation, and, you know, I love that about Nick, is Nick basically taught himself how to do this and to give this presentation. And so and we start simple, very, you know, with lemonade stands and things like that. And hopefully most businesses start in a similar fashion. Most businesses, they tend to start very simple and they gain complexity over time. And there's something good about that because you have a chance to learn as your business you know, hopefully grows and also becomes more complex. So in terms of the balance sheet, you know, as an executive director, so Betty as a bookkeeper knows way more than me, and then CPAs get into a whole other different realm that will do a lot of brain damage if you're not careful. But what I look at the balance sheet for often, I mean, debts are obviously one of the big parts of what we're looking for, how much cash we have, this idea of liquidity, because a business normally has these cash needs over time, and you have to make sure that you have the cash available. Balance sheets can also give you a sense of when it is you might need to ask for financing, go and look for a loan in case you need money to be able to do something that's essential for the organization. So I'm one of those people that looks at it in a very, very general way. And Betty, who is our bookkeeper, she'll tell you that there are definitely times I call and I'm like, wait a second, I don't understand exactly what happened on the balance sheet. You know, I'm sort of smart enough to cause problems with it, and so that's why also we're a little more complex. You know, we have about $7 million in assets in a whole bunch of different charts of accounts. so I don't have to know everything, and that's one of the things I want to point out to everybody. It's okay that you don't, if you didn't understand every single term or know everything that Nick was talking about. It's something that you learn over time, and I suggest starting simple. And Betty will tell you, most of my questions are relatively simple. They're like, how do I wrap my brain around this? I forgot exactly how this works. But it's something that I look at as a director of an organization. I look at least on a monthly basis. I may look at it a little more often depending on what activities we're doing at a time. But it's just one of those things I would encourage you not to be afraid of it. There are people that can help you. We are people that can help you. We're trying to show you. I'm a creative writing major out of college. So the idea that I'm looking at financials it tells you that if I can do it, anybody can get a sense of it. And so I do think that's part of what we're trying to look at. I look at it for really kind of big macro items. That's what I look at on the balance sheet, and I do compare year to year just to see how we're doing. And building assets is just in general. I mean, it's probably obvious, but it is important for business. It's what lenders look at. They want to know that you have assets that can secure loans, that can, in cases lending, if you're anybody that you're dealing with, if you wanted to sell your company, they're going to look at what your assets are. They will look at your liabilities too, but we're always trying to sort of build our net assets as a business. That is something that shows you that you're headed in the right direction.
Great. I'm going to take one more stab at answering Melissa's question, and I'm going to try and do a screen share here. So let me pull the screen back up. Okay, so I'm going to highlight that. All right. Okay, so Melissa, let's say I'm using the same lemonade stand as the example. Let's say you're coming to do your balance sheet, and you've just done your profit and loss statement. And so you need to add the profit from your most recent year into this section, the net profit. So let's just say, for example, that your net profit would have been $10,000, but you went ahead and you added a line of $1,000 expense of depreciation on whatever the piece of equipment or vehicle might be. So instead of $10,000, your net profit is actually now $9,000. So I'm going to make two changes. So $9,000 goes here. We're out of balance. Our amortization in this first year is $1,000, so that's negative. So that goes under fixed assets. And then we have to think about, like, well, what about that $10,000? We initially said it was $10,000, so you literally earned $10,000 net profit. And then we threw in this $1,000 depreciation expense. That expense isn't really real in the sense that that didn't cost you $1,000, that you didn't lose that $1,000 of cash. So you actually have $10,000 of cash on hand. And so your account over here that says cash is going to go from $15,000 to $25,000. And so that difference right there, where you had that $1,000, it ends up getting made up for because you actually have more cash. You have that extra cash, and then you have the minus $1,000. So this left-hand side still ends up balancing with the right-hand side because you had that $9,000 net profit that took into account the depreciation. So that's my best attempt. That's sort of what I was saying. If you just kind of follow those rules, and if you're gonna do depreciation, just be sure that you're deducting it from your profit and loss, and then you're also adding it to your balance sheet as a negative number, and everything should work out in the end in terms of, like, well, the cash or an asset or whatever that you bought with that cash would still hit the balance sheet in the proper way. So great, I'm glad that was helpful. Okay, any other questions from folks, or Danny or Betty? Danny, go for it. I think you can unmute yourself, right? Here, I'm unmuting you.
Thanks. Sorry, you did for me before. One thing I also just wanted to talk about as we were doing some of the simple stuff, and I'm sorry, Nick, I'm going to say Nick asked me to come in to try to potentially fill in some gaps if I heard any during the presentation, is when we were looking at some of the values and choosing between this lemonade stand or that lemonade stand. And if you were looking at different businesses, also understand that scale is important. So the idea that a small lemonade stand may have a net profit, and let's say the net profit is $10,000, but then you have a business that is has just millions and millions and millions of dollars of assets, but shows a net loss in a year. There, and even on the balance sheet, if you potentially have negative, that's not a good sign at all. But with scale, there's also opportunity to fix things, and there are opportunities to run businesses differently. So it's not as simple as saying, "Hey, do I want a business of do I want a $10,000 lemonade stand, or a company with multi-million dollars worth of assets?" And to know and to say one is worth more than the other in this sort of net worth idea. And so that, again, I think we are starting small, but we do want you to understand that we understand those complexities too. As you have more resources, assets, and including liabilities, there are also different opportunities that come with that. You can kind of do more with more. You can also mess up with more. So that's a part of it as well. But I just wanted to state that we understand that reality. We've simplified for a reason, and we hope we can build on this, and that you can build on these sort of foundational points, getting you to understand the basic concepts first. So.
Yeah, thanks for adding that. And I'm going to ask you something here again in a second, Danny, but it is just worth pointing out, like, as a very initial concept, the idea of net worth is easy to wrap your head around. And so that's kind of why I use that term. But owner equity maybe makes a little more sense in that, like Danny's saying, the net worth, it's more complex. If you're actually thinking about, like, well, what is this business worth? It's not just that number of net worth. And so I don't know, Danny, if you would want to comment on, like, profitability. Is that something else that we would take into account when evaluating how much, like, if you're actually going to buy a business, what else might you look at?
Profitability for sure, net profit. Normally, often people are looking, quite honestly, there are two ways to look at businesses. If you were looking to purchase to get into one, you look for an opportunity. So maybe a business that isn't doing well, that you have some sense of how you could turn it around and make it more profitable quickly. That's one approach. And then there are other people that, when a business is profitable, and the reason is because you'll pay less for that business that isn't working as well, versus a business that is working well and making a profit. And so if you were to buy a business like that, you're probably going to pay more because it's already doing well. So there are different sort of thoughts around it. And the other thing is, which people should understand, if that is, and we know we're dealing with startups and things, if you are looking to purchase a business, understand that people can potentially be loyal to the business for its existing management. There isn't going to be zero hit, for instance, on business. And one of the ways I say that is, we've seen people, like, who wanted to buy a pool cleaning business per se. And so if they bought that, they come with a list of customers. But if they continue to do things as well or better than the previous management, you may lose customers. So, somebody saying, well, here's how much it makes, you may want to build in some attrition of people leaving a business like that. I'm not sure that's as, and again, it depends on the industry. And it's one of the things that happens when we look at, when we go and look at giving loans, is that we look at, do you have industry experience? Do you know about this industry? Do you know how these things work? If you were looking for a loan to, to help purchase, additional customers or things like that. So there are a lot of different ways to to peel the layers back on this onion. And it's something that we are generally wanting people to go with what are your core strengths? What is your core knowledge? What is, do you have experience in the industry? Because we trust, and most lenders do trust that more than somebody who, just got an idea and has some money and wants to, they always dreamt of running a lemonade stand. So, but maybe they know nothing about it. Having some knowledge about it is actually important, because running businesses are not necessarily easy to do. So yes, Nick, I hope that helps or adds a little more depth around looking at the opportunities and looking at a business. Also, a business. The one other thing is, the longer it's been around, the more well known it is. Those are things, and they can show up on balance sheets. Sometimes they're called goodwill, is how they can show up on balance sheets. But a brand also has value to it, and building a brand over time, has added value versus a business that's only business 1, 2, 3 years. That may be a harder business to sell, or there isn't as much value in it because maybe not as many people know about it, for sure. So, El Charro downtown as a restaurant, everybody in Tucson has mostly heard of El Charro. That's, if you were to buy that business, if they were selling, you would pay some for the sort of the cachet of El Charro's name when you're doing that, and there's value in that. And that's another thing that people try to build over time, is sort of their visibility and their brand, and those things that are also important when you're looking at the value of an organization.
Great. I just shared the link because I think that there was a mistake earlier, perhaps, in the balance sheet template. So this is the one that you saw me pull up on the screen, and does all the math for you. And Betty, unless there's anything you wanted to add, or are there questions for Betty? Betty looks like she's good. So I'm gonna share the survey for this class. If you guys still have a minute, we would encourage you, because again, this whole thing is a work in progress, and we really want your feedback on what was confusing, what was helpful, what was not helpful, and what we should do next. So take a couple minutes if you can to just click that link in the chat window. And yeah, thanks so much to everyone for joining. And again, we will send this link out to you guys if you want to rewatch certain sections. Like some of the stuff it's hard to wrap your head around. The balance sheet is more complicated than the profit and loss statement. So it may take a couple watches to kind of get through it. So with that, thank you guys so much for being here, and you'll hear from us in a follow-up via email, and we hope you're well until then. And I will now close the videos.